Imagine for a moment that you're standing in front of a massive puzzle. Every piece represents a business decision, a financial move, a market opportunity. When two giant companies announce they are merging or one is acquiring the other, that puzzle suddenly shifts. Entire industries tremble, competitors adjust their strategies, and investors around the world search for the hidden clues inside the chaos. This is the world of mergers and acquisitions, and understanding how to analyze their impact is like being able to read the secret map that shows where the treasure is buried. Most people hear about big corporate deals only in the headlines: Amazon acquiring Whole Foods, Disney buying Marvel, or Microsoft taking over LinkedIn, but few truly understand how to take advantage of these events as investors. And that's exactly what we are going to uncover today: how you can benefit from analyzing the impact of mergers and acquisitions, so you don't just watch the puzzle shift, but actually position yourself to win from it. So let's start with the basics. A merger happens when two companies join forces to become one stronger entity. Think of it like two rivers flowing together to form a more powerful current. An acquisition, on the other hand, is when one company absorbs another, almost like a shark swallowing a fish. Either way, these moves create ripples across the market. Stock prices can soar or crash, industries can consolidate, and competitors might suddenly be forced to reinvent themselves. For the average person, this might sound distant, like something that only concerns CEOs and Wall Street insiders. But here's the truth. If you know how to interpret these moves, you can identify investment opportunities before the crowd, you can position yourself to minimize risks, and you can ride the waves of change instead of being drowned by them. Now, let's dig deeper into why these corporate maneuvers matter. Imagine a large company acquires a smaller, innovative startup. That acquisition might mean they're doubling down on a new technology, signaling the direction the entire industry is heading. For example, when Facebook bought Instagram back in 2012 for $1 billion, many thought it was overpriced. But if you had understood the potential of social media and the trend toward mobile content, you would have realized Facebook had just secured its future. Today, that single move is worth hundreds of billions. Here's the power of analyzing acquisitions. They reveal where the giants of the market believe the future lies. But let's flip the perspective for a moment. Not every merger or acquisition is a guaranteed success. Sometimes companies overpay, sometimes the integration fails, and sometimes cultural clashes destroy the expected value. Think about AOL and Time Warner, a deal once called the merger of the century that turned into one of the biggest disasters in corporate history. Investors who blindly followed the hype ended up losing fortunes. This is why a careful analysis of impact is essential. By studying the financial health of the companies involved, the logic behind the move, and the potential synergies, you can separate the winners from the ticking time bombs. At this point, you might be wondering, how exactly can you, as an investor, benefit from this knowledge? Here's where things get exciting. When a merger or acquisition is announced, the stock of the target company, the one being acquired, usually jumps because investors anticipate a buyout premium. If you're able to identify potential acquisition targets early, you can invest before the announcement and capture massive gains. On the other hand, the acquiring company's stock might initially drop because investors worry about debt or integration risks. But if you analyze the deal correctly and see long-term value, this temporary dip might be your golden entry point. This is why learning to think like a detective pays off. You're not just reacting to headlines, you're interpreting signals. Ask yourself, does this acquisition strengthen the company's market position? Does it unlock new technologies, customers, or geographies? Are there clear cost savings or revenue synergies? Or is it simply a desperate move to survive in a competitive market? The answers to these questions can transform a risky situation into a strategic advantage for your portfolio. Before we continue, let me pause for a quick moment. If you're finding this eye-opening, and you're serious about mastering the secrets of investing, make sure you hit the subscribe button to join our Investor School community. Every week we share powerful insights that help you think differently, see opportunities others miss, and build real confidence in your financial decisions. Now, let's keep going. Another layer of analysis comes from understanding industry-wide effects. Let's say two massive players in the pharmaceutical sector merge. That doesn't just affect their stocks, it reshapes the entire competitive landscape. Smaller competitors might suddenly look vulnerable, or they might become attractive acquisition targets themselves. The ripple effect can spread across suppliers, distributors, even unrelated sectors. If you can map out those connections, you'll see opportunities that others completely overlook. This is how professional investors think. They don't just focus on the deal itself, they analyze the ecosystem around it. And here's where emotions come into play. When big mergers are announced, markets often overreact. Fear and greed take over. Some investors panic sell, others rush in blindly, hoping to strike gold. But if you keep a calm, rational perspective, you can exploit these emotional swings. While the crowd chases rumors, you're focused on facts, on fundamentals, on the real long-term value. This discipline is what separates the speculator from the strategist. Let's not forget about timing. Timing is everything in investing, and mergers and acquisitions are no exception. Right after an announcement, you'll see a lot of volatility. Prices may spike or crash, but the real money often comes from waiting, analyzing, and positioning yourself once the dust settles. Some of the best gains come months or even years after a merger, once the synergies kick in and the new company proves its strength. Patience is your secret weapon. To give you another powerful example, think about Disney's acquisition of Marvel in 2009. At the time, the deal cost just $4 billion. Many questioned whether superhero movies could truly dominate the global market. But Disney saw the bigger picture. Not just movies, but merchandising, theme parks, and cultural influence. Today, that single move has generated over $50 billion in revenue. Investors who understood that vision reaped incredible rewards. That's the kind of foresight you can develop by learning to analyze the impact of mergers and acquisitions. So here's the big takeaway. Every time you hear about a merger or acquisition, don't just treat it as news. Treat it as a clue, a signal, a piece of the larger puzzle. Ask yourself, what does this tell me about the future of this company? What does it reveal about the industry? Where are the hidden opportunities, and where are the risks? By training yourself to think this way, you'll stop being a passive observer and start becoming an active player in the financial game. And remember, the market is a story constantly being written. Mergers and acquisitions are plot twists, sometimes shocking, sometimes brilliant, sometimes disastrous. But if you learn to read the narrative correctly, you'll always be one step ahead of the crowd. You'll know when to act, when to wait, and when to seize the kind of opportunities that can change your financial future. So the next time you see that headline about a billion-dollar deal, don't just scroll past it. Stop, think, analyze, and ask yourself, what does this mean for me as an investor? Because the truth is, those who learn to decode the hidden messages behind mergers and acquisitions are the ones who consistently find themselves on the winning side of the market.